Can you get a mortgage with bad credit? Here's the thing. Absolutely, we're going to go through it in this episode, how to get funding for your deal, even with bad credit. A lot of people just look at what is typical lending, which is you go to a bank or you go to a broker, right? So your bank, they have a certain amount of options. Typically a broker has a little bit more options. Depends, like a bank's a great place to get a mortgage if you have a solid relationship and they're easy to work with, right? A broker, you got to vet these people out, but a broker could have a little bit more options than your traditional bank. So dealing with a broker, again, you may want to shop it and see who could get you the best rate and term. This is, a lot of people understand this part. It's, mortgages, it's kind of what's traditional, which is not traditional for what I do. I like to find alternative ways to get the funding for my investment property. So we're going to talk about those. But again, I just want to recap real quick before we get into those. If you're getting a traditional mortgage on an investment property, whether it's like a single family up to 4 units, you would go to a broker or your bank and they could typically fund those things. So what you need to consider is you need to consider your credit score. Like your credit score is important, especially when dealing with one of these institutions. So making sure, like, you could go to Credit Karma, you could get your credit checked, make sure, if your credit's low, you want to work on that. You could hire somebody to help you with it. You don't have to have good credit to buy a piece of real estate, but I will tell you from experience, it opens up more doors for you when you have good credit. And so just having those additional options is sometimes great. Saves you money because, if you have bad credit or unfavorable credit, you pay higher interest rate, which does what? Eats into your income, which eats into your cash flow. So anyways, just something to think about. Another thing to think about is debt to income. When you are looking at an investment property, you need to take into consideration what would be the cash flow on it. They're going to take a certain amount of the rents, a certain percentage of the rents. They're going to look at what you make, etc., and then what your debts are. Maybe you have a car payments and things like that. So credit card payments, So you want to take those things into consideration when figuring your debt to income. It's always good to get pre-qualified and know exactly what you could qualify for. I say that, but I never do. That's if you're doing it the traditional way, right? So if you're buying your own personal house, or maybe it's your first or second rental property or something like that, I'm really excited to get into these other options for you guys, which will open up more doors for you as well. So, and again, credit score, debt to income, what you could prove, all that good stuff. You want to have your assets, your liabilities, all those things kind of figured out. What you don't want to do is, when you're getting pre-approved, is go out and take on a line of credit, go buy that new car, truck, rack up a credit card, something like that. It happens all the time. People do it. I don't know why, especially when you're buying something that's going to produce income and then you go and waste that money. Anyways, alternative ways to buy investment properties. That's the stuff I want to get into right now. Make sure you give me the thumbs up. All right, let's get going. Oftentimes, you'll hear me say this. If you've listened to any of the other videos, you'll probably hear this. If you know how to find the deal, you'll find the money. All right, find the deal, you'll find the money. If you do that, your credit score really doesn't matter, okay? So I torpedoed my credit after 2008-9. We talk about that. It's another story for another time. But I had to get creative on how I acquired properties. So I got really good at finding deals. So good that people would want to work with me. They'd lend me the money. They'd want a little piece of the deal, whatever it is. You could take on partners this way, right? You could raise money this way. So think about it like this. If you found a really good deal and you don't have the money, but there's a lot of equity, a lot of income that could be produced from it, whether it's from a cash flow perspective or from just fixing it and selling it, you'll get people to participate with you. So just think about that. Like, especially, let's say there's $100,000. I'm going to go ahead and do the work. This was me talking. I'll split this with you if you fund this deal. Well, what's their money doing anyways? It's just sitting there. So why wouldn't they want $50,000 in that situation? They would. So again, finding the deals, you're going to find the money. Once you learn how to find the deal, you have a trait that nobody else could take from you. And it's something that most people are not going to spend the time to get vested into that and networked to be able to find the deals like you're going to. So partnering with somebody. You have hard and private money on that as well. So let's say you have some capital, you just want to take the deal down fast, or interest rate doesn't really matter. You could use private or hard money. Often the times they're very similar, the same. I get very low interest rates from private money most of the time, but it just depends on how you're classifying it. People use them in the same terminology often. It's fine. So think about private or hard money, where they're not necessarily taking your credit score fully into consideration. It's not the deal killer. They're more looking at that asset in the deal, and does the deal make sense? If the deal makes sense, they're going to invest in it. When you're partnering, we'll go back to that. You could work with other investors. If you're new, I think working with an investor is a great opportunity. It's the way I got started. I would find the deals. I would bring an investor in, split that deal. I think they got 30%. They would bring the money, kind of an expertise, allow me to network even more, and they got paid to do it. They got paid during the process too, in the form of a hard money payment, but they kept 30% at the end as well. That's okay with me. I learned a lot during that time. I'd do it all over again. Another unlikely area, a lot of people never think about this, is if you have a really good deal, you could talk to friends and family. Like, friends and family often have money that they haven't necessarily talked about. It's weird. They don't walk around and tell me how much money they have. But a lot of times, if you're talking about a deal, people will say, hey, I think I could participate in that. Whether they have money saved, they could have, and you could have a line of credit, so things like that. Also, you could take a loan out on a 401k if you have one, or a family member has one. So you could leverage these other assets or retirement accounts and things like that to get the money for a down payment or for the entire property, and then do multiple different ways to fund it, whether it's through that, the line of credit, hard money, you name it. So I want you to keep an open mind when you're thinking about how to fund these projects. Don't like, well, I need to save up this $400,000 to buy this. It's the wrong way to look at real estate. Leverage, leverage, leverage. Get yourself going and get yourself in the deal. If you find a deal and there's equity, do everything you can to get in that deal. Protect that equity and take as much down as you can. The last and my favorite is through syndication. Raising capital through syndication, which is getting either one or a handful of people to participate, raise the capital for. I'll give you one, for example, of a building I bought. It was a medical building, needed to be repositioned. It was ugly, hadn't been touched since the 70s. Nasty, that yellow glass and all that fun stuff. Anyways, my vision for the property, and when I did the underwriting on the property, it was $850,000 purchase price with a $300,000 rehab. So what is that? So a 115 final price. I figured it was worth somewhere around, based on the square footage, if I was able to get my price per square foot correct, would give me about a $2 million valuation when it's all said and done. Anyways, through that process, I raised money not just for the purchase, but also for the rehab through syndicating, through bringing multiple people in on that project. Then once it was rehabbed, stabilized, repositioned, if you will, we put it on the market, and then we ended up getting that $2 million mark, executed, and split the funds accordingly. The way I did the deal, and just as a structure standpoint, so you guys understand, I structured that deal where the two main people, myself and the main person that brought in the majority of the money, we were each 45% each. So we, between the two of us, made up 90% of that deal. The last person made up the last 10%. And so in doing so, think about this. I brought $0 to the table and kept 45% of the exit or equity once it was sold. So you could do the same. And it's typical if you're syndicating deals to get a minimum of that on the exit, right? If it's cash flowing, you could keep that 45. It goes as high as 70% on the exit. Depends on how generous you want to be. I did 45. I kept it very simple across the board, just so I didn't get stuck with crazy math and have to do stuff later. 45% seemed good. They got me in the deal. Again, I did what I would call the heavy lifting. I did the repositioning, redesign of the building, and got it leased up with brokers as well. So it was a group effort there. But again, I got to keep 45% of the end plus the cash flow during that process as well. Something to think about. Minimum would be 25%. Typically for a new investor, if you find that deal and do something very similar, again, this is all in negotiation. There's nothing set in stone. I'm just telling you kind of what I do and what I see other people doing. It's a phenomenal way, again, for you to get into a deal and fund it. So if you'd like to learn more on how to do this, and you're like, hey, this sounds great. Where do I start? Where could I learn more? Click on the link below. Schedule an appointment with myself or one of my team members. We'll get you started today, at least going in the right direction. Thank you.